What is up, future CPAs and Gen Z accountancy students? Welcome to the explainer that is literally going to change the game for how you prep for the taxation boards. We're not doing that boring brute force memorization thing today. No way. Instead, we're going to track the hero's journey of a single asset, from the exact moment it's acquired to how it survives the market, and finally, its ultimate destiny at disposal. Master this one journey, and you're locking in this knowledge for that entire 3-year grind to the LECPA.
So, ask yourself this. What's the #1 reason candidates actually fail the tax boards? Is it a lack of intelligence? Definitely not. It's cognitive overload. The Philippine tax code is absolutely massive, and trying to memorize isolated rules is like the ultimate boss fight in the LSCPA. Your brain just runs out of RAM. To beat this, we've got to encode the info using spatial mapping and logic, so it actually sticks in your long-term memory.
All right, let's dive right into the battle plan. We've organized this into 6 mental folders to beat that overload: asset classification and basis, holding periods and capital losses, capital gains tax rules, principal residence exemptions, wash sales and tax-free exchanges, and finally, some LCPHA cheat codes.
Starting with Section 1, Asset Classification and Basis, also known as the asset's origin. This is stage 1 of the life cycle, where we discover the asset's true identity and figure out its starting value, or tax basis.
Check out the stark contrast here. Under the Philippines setup, an asset's entire tax destiny basically hinges on whether it's a working, ordinary asset or a resting, capital asset. If it's inventory, depreciable equipment, or real property actively used in a business, it's ordinary. Boom. Any gain is 100% included in ordinary income. But if it's a personal asset, non-business property, or just a pure investment, it's a capital asset. And that opens up a totally different rulebook.
But hey, what happens when an asset just gets tired? Let's say a business, specifically a non-real estate business, has real property it just stops using. If you can prove that property has been completely idle, completely unused in business for over 2 years prior to the transaction, the tax code actually auto-reclassifies it. It magically transforms right from an ordinary asset into a capital asset.
So a crucial point here is exactly how this asset was born into your hands, because that dictates its tax basis. Take a mental snapshot of this matrix right here, because spatial mapping is a massive cheat code for your brain on exam day. You buy it, it's your cost. You inherit it, you get a step up to the fair market value at the time of death. If it's a gift, you carry over the donor's exact basis. And if you bought it for less than it's worth, inadequate consideration, your basis is simply the amount you actually paid out of pocket.
Moving into Section 2, holding periods and capital losses, or the trials of time. Our asset is alive, classified, and facing market fluctuations. And this is where the rules bend, depending on exactly who owns it.
Look at this ultimate nerf the tax code places on corporations. If an individual taxpayer holds a capital asset for more than 12 months, they get this massive 50% discount on recognizing that long-term gain or loss. But corporate taxpayers? No way. They take the full 100% hit on capital gains and losses every single time, totally regardless of how long they've held it.
Let's pause for a second. Search your brain. We know capital losses are strictly allowed only to the extent of capital gains. But what if you have a net capital loss? If an individual can carry that loss over to the next year under the NCLCO rule, can a massive corporate giant do the same thing?
Boom. Absolute prohibition. Only individuals get that net capital loss carryover lifeline. For individuals, you can carry that net capital loss over to the succeeding taxable year as a short-term capital loss. But watch out, there's a strict cap. It cannot exceed your net income for the year the loss was actually incurred. In corporations, 0 carryover. The second the year ends, that net capital loss just vanishes into thin air.
All right, Section 3, capital gains tax rules, the asset's ultimate destiny. We're at the point of sale, and depending on the asset, disposing of it triggers the dreaded capital gains tax, or CGT.
Let's dive into these 2 massive anchor numbers you absolutely need for the LECPA. Notice how real property classified as a capital asset in the Philippines is taxed on the gross value. You're paying a 6% final tax on whichever is higher between the selling price or the fair market value. Unlisted domestic shares of stock, though, fundamentally different. They're hit with a flat 15% final tax, and it's strictly on the net capital gains, meaning your selling price minus your tax basis.
Section 4, principal residence exemptions, the safe haven. Because what if our asset is literally the roof over your head? The government actually doesn't want to punish you just for moving houses.
So follow the mathematical logic here to see how you get a safe haven from that 6% CGT.
If you fully reinvest the proceeds from your old principal residence into a new one, you shield yourself completely, and your new home just carries over the tax basis of the old one. Reinvest less than full? You'll pay a prorated CGT based on the unused portion of your gross selling price. And if you go all out and spend more than your proceeds, you are totally exempt. Plus, you get to add those extra costs right onto your new tax basis.
Now for Section 5, wash sales and tax-free exchanges, or the exploit codes. These are the highly technical maneuvers, the legal reorganization exploits, and the traps the BIR sets for the unwary. The absolutely crucial point here is this exact 61-day window. If you're a non-dealer in securities and you sell shares at a loss, but then you turn around and repurchase identical shares within 30 days before or 30 days after the sale, you trigger a wash sale. The tax code basically assumes you're just trying to harvest a paper loss without really letting go of the asset. And the penalty? Your loss is entirely disallowed. Let this massive number burn into your retinas right now. For Philippine tax reorganizations, 51% is your ultimate control threshold. If you see this percentage on the exam, you're almost certainly looking at a very specific tax exemption. Here's exactly how that tax-free exchange works under Section 40C2. If you transfer property to a controlled corporation and 5 or fewer people achieve that magic 51% collective voting power, boom, no gain or loss is recognized. Instead of paying tax right then, your basis just substitutes. The basis of the property you transferred becomes the basis of the shares you receive. It's a literal pure tax deferral.
Finally, Section 6, LECPA cheat codes and review. Leveling up. We tracked our asset from birth all the way to disposal, so let's compress this into pure brain hacks.
Take a screenshot with your mind right now. Grouping information just like this is exactly how you lock in that 3-year retention. When you read a question, always ask, who is the taxpayer? What is the asset's identity? Matrix the basis, anchor those rates at 6 and 15%, and watch out for the 2-year idle rule and that 61-day trap. Skipping the fluff and holding on to this core data structure is how you navigate the trickiest questions the examiners will ever throw at you. So think about it. If an asset's identity dictates its entire tax destiny, are you misclassifying your most valuable asset, your own study time? Treat your focus as your ultimate capital asset. Master these structures, keep reviewing this explainer whenever cognitive overload tries to creep in, and just go crush those taxation boards. Because if you can master the journey of a single asset, well, what happens when we start mixing them together in corporate liquidations? You've absolutely got this.